Good evening, everyone. For those of you that don't know me, my name is Vicki Seitz, and I'm the retirement manager here at the school district. Myself and Carol Powers, who assists me, are the people that handle retirement and several other things. So please be patient if you've been trying to get a hold of me. I keep a list, and I do get back to everybody. Tonight's presentation is about 3 hours, and I will start off with just some general information about the district's website, and then I will introduce Rich Clifford, who is from the Florida State Retirement System, and I am terrible with microphones, so please bear with me. And then Karen Cooley's going to come in. She's going to talk to you a little bit about retiree insurance. And then Mike Stevenson and Rob Kemp are here from the BenCor Special Pay Plan, and they will go over the BenCor Special Pay Plan so that you guys will have a better understanding of BenCor. It's a little hot in here, isn't it? I thought maybe it was just me, but I guess it's not. All of you should have completed a computer registration out front. Hopefully you did. I will be sending out in a week or so the survey, and we'd like you to participate in the survey because we would like continuous improvement on the seminars. Please turn your cell phones off if you have them, or put them on vibrate. That would help out a lot. We're on a tight schedule. You guys have an agenda in your packet, and we would like to try to stick to that if we could. Feel free to enter and exit between presentations. Try to keep movement during presentations to a minimum. If you go out that door, down the hall, back out into the lobby, the restrooms are out there. The seminar is really geared towards pension plan retirement members. If you're an investment plan member, there may be some information here that's valuable for you. I did want to let you know that I did send out email notifications. We're having some workshops. There's a workshop on the 29th here at the district in the boardroom at 5:30, and it is about estate planning and information on how to protect your family. We've had one here in the fall. We had really good attendance and very good feedback on it. On February the 5th, there is a workshop presented by the Florida Retirement System, and it is about investment plan. It's about how you use the investment plan to retire, or if you're thinking of switching plans, they're going to talk to you about whether that's a good move for you to make. And on the 12th is income tax planning. I've never had that presented here, so I don't really know what it entails, but normally these workshops are very informative and they're very helpful for you in your financial planning future. So if you haven't signed up, or if you have a question about signing up, you can certainly give me an email. On your packets is my business card, and on my business card is the district's retirement, here I go with this microphone, is the district's retirement website, leeschools.net/retirement. There are links on there, and on my business card is also the website, and on the back of my business card is the website for myfrs.com, and the DMS, which is the Department of Management Services, or FRS Online. There's the email to the FRS's retirement department. If you send them an email, put in the body of your email the last 4 of your social, because that's how they track you. Don't put your whole social, but the last 4 will help them. There's the phone number for pension plan members and the phone number for investment plan members. And for appointments, that is the email address, and that is Carol Powers. She assists me with my calendar. So please make use of that information. If you have questions, sometimes you can just get your answer from the district's retirement website. On that retirement website, I'm going to go through this quickly, is this information about general eligibility for retirement for pension plan members and investment plan members. There's free financial planning provided by the State of Florida Business Administration through FRS, and this is the information on the MyFRS financial guidance line. There's also cards out on the table. If you leave, you may be able to pick one up. I had to order some more, but it also has information on the MyFRS financial guidance line. It's a free service to all the FRS members. They are unbiased because they can't sell you a product. So if they recommend a type of mutual fund, they're not selling it to you and they don't make any money off of it. There's a little bit of information on drop, and I hope to beef that up a little bit. And there's the DMS website, what's in there. There's retirement guides. Unfortunately, I don't have any paper guides. I don't get them anymore. I did order them again because I keep trying. I'm hopeful, but so far I haven't had any sent to me. So you can go online, and the links are there to the retirement guides. Do you want to request an audit estimate of your account? If you haven't done so, you can click on that link. Takes you right to FRS. Then there's reemployment rules for retirees, and that's very important. You need to review that and make sure that you know what the reemployment rules are if you're going to retire and you want to return to work. I don't know why, but if you have a dying need to return to work, there are some rules. And then there on the side there are some related links. The retirement seminar, this will be videoed, yay me, and it will be on the district website. There's an FRS PIN request. There's information on how to get your FRS PIN number. There's information on terminal pay, which is your sick leave and your vacation payout. Retiree insurance links you to insurance and benefits, and the costs for retiree insurance are out there on the website. Insurance and benefits is the department that you talk to about insurance as a retiree. There's FRS members resources. There are your member annual statement. If any of you have ever gotten your annual statement and you wonder what happened to it, it's now online, and they send you an email. And people think it's a phishing email. It's really not. It's from the state of Florida. If you're in drop, you no longer get that member's annual statement. There's retirement, FRS retirement FAQs, and staff. It just has my contact name and number and Carol's. So that's just a brief overview of the retirement website. One thing I do want to say is people have been contacting me because they're contacted by companies that represent themselves as FRS. These seminars that I present are from FRS. If you're getting one from Suncoast, Suncoast is research things. If you're getting one from Voya, they are all vendors that the district uses for 403Bs and 457s. So they are companies that the district has looked at and said, yes, you can offer services to our employees. There are other outside companies that offer classes and such. So these are not bad things. It's good to inform yourself. Just make sure that you know who you're talking to and whether it is actually FRS or not, or if it's a district-approved company. As I said before, there's a list of 403B and 457 on the Insurance and Benefits website. Sorry, I lost my train of thought. Under tax-sheltered annuity or tax-sheltered accounts. So you can check and see if the person that you're talking to is someone that the district has, added to their website and contracted with. So there's Voya, there's Suncoast, there's Fidelity, there's Bencor. There's a lot of them out there. There's AXA. So go out and look at the lists, and if you're interested in the 403Bs or the 457s to additionally add to your retirement, those would be the companies that you would talk to. So now I'm sorry, I'm getting dry mouth. Now I'm going to introduce Rich Clifford. He's going to talk about how your retirement is calculated and talk a little bit about drop. And then we'll move on when Karen Cooley comes into insurance and benefits. So I'm going to pass the microphone on to Rich. Yes, I have a clicker.
Okay, great. Oh.
And I'll go up and change the...
Okay, she's going to be putting can everybody hear me? Okay, well, listen, first of all, I want to thank Vicki Seitz for once again inviting me to come out to you guys to speak to you today about the FRS pension plan. And I also want to thank each and every one of you for coming out today as well, because I think you've taken the first step in preparing for retirement. And the better that you understand your retirement when you submit your retirement application, or if you're submitting your drop application to go into the deferred retirement option program, the better prepared you are and the easier our job is, because the section of the division that I work for is a section that is going to process your service retirement application and get you on retired payroll, or if you're applying to participate, retire through the drop program, we're going to process your drop application and get you on into the drop program. So bottom line is, my presentation to you today is based upon 3 publications. And in the hour and a half or hour and 15 minutes that I have to present to you today, I can't tell you every single little bit of information that you need to know about retirement. And also, you're probably not going to remember everything that I need to tell you. So it really is incumbent upon you to read these 3 publications that I'm referencing to solidify in your mind the understanding of your retirement. The first publication is the FRS Member Pension Plan Member Handbook. If you read this handbook will tell you everything that you need to know about how your FRS pension plan benefit works. The second guide that you should be reading is the Ready, Set, Retire guide, because this guide is going to tell you everything you need to do in preparation for retirement, what will happen when you retire, and what will happen after you retire. And you should be reading that at least a year out from your anticipated retirement date or drop entry date. The second booklet, if you're contemplating retiring through the DROP program or the Deferred Retirement Option Program, which is what the acronym DROP stands for, then you'll want to read the Deferred Retirement Option Program guide. If you read this guide, this will tell you everything that you need to know to understand what DROP is. So all these publications can be found on the Division of Retirement's website. Now, I know Vicki gave you a very complicated website because the Division of Retirement falls under the Department of Management Services, or DMS. So we are a division of that department. But if you go to www.frs.myflorida.com, that is the Division of Retirement's website. And if you go down on the navigation bar on the left-hand side of the page and click on Publications and then click on Retirement Guides, this is where you will find those 3 guides that I just referenced to you. All right, so like I told you before, I can't tell you everything that you need to know about DROP. And in my attempt to make things simple and trying to convey how the pension plan works, ultimately, if there's anything that you've misunderstood that I've said or anything that you question that you read in these publications, the Division of Retirement, which administers the FRS pension plan, has to follow state statute. It's our legislators that create the laws, or that create the bills that go become law, by which we have to administer the FRS pension plan. And the retirement statute is Chapter 121 of the Florida Statutes, and they're Chapter 60S of the Florida Administrative Code, as well as, because your retirement benefits are taxable, the Internal Revenue Code remains the final authority. Now, because it's pertinent to future slides in this presentation, I need to give you a little historical background on the FRS. When the FRS was first created in 1970, it took 2 old plans, the Teachers Retirement System and the old State and County and Officers Employees Retirement System, and merged them into the FRS. And when the FRS was first created, there was only one plan under the FRS, and that was the FRS pension plan. And when the plan was started, it was an employee contributory plan. And of course, what happened was the legislature passed a bill that went into effect in January 1st of 1975 that said employees no longer had to make employee contributions. And of course, we know the legislature passed another bill that went into effect on July 1st, 2011, that said employees now have to make those 3% employee contributions. So we started seeing the 3% employee contributions come out of our paychecks to go towards your FRS benefit. Now, what happened was, in about the 2000 legislative session, the legislature created a second plan, or an alternative plan, under the FRS. And that plan was the FRS investment plan. And so each and every one of you that was in this room when that plan was offered beginning July 1st of 2002, okay, you were given a plan choice to choose between the pension plan or to elect to go over to the FRS investment plan. And if you made no election, by default, you went into the FRS pension plan. So that's for all of you in the room, but beginning next year, or January 1st of actually this year, January 1st of 2018, anybody initially enrolled in the FRS, if they don't make an election during their initial plan choice, they are going to default to the FRS investment plan. But for all of you here, you defaulted to the pension plan. Now, you do have a one-time second election while you're actively employed, prior to retiring, prior to entering into drop, to switch plans, okay? However, there are incredible differences between the two plans. So if you've spoken to someone or a friend or a financial advisor who may or may not have, some ulterior, motivation to direct you to one plan or the other, and I'm not saying that's the case, but sometimes that is, you really should be calling the FRS guidance line at that 866-446-9377 to fully understand the differences between the two plans before making that one-time second election. The FRS pension plan, okay, which is administered by the Division of Retirement of the Department of Management Services, is a defined benefit plan, meaning that when you retire under the pension plan, your benefit is based upon the benefit formula, okay, which is your years of service times the accrual value that you get for each year of service times your average final compensation. So the contributions that you have been making and that your employer has been making on your behalf have no correlation to what your retirement benefit is, because your benefit is based upon the benefit formula. Those contributions are going into the FRS trust fund, which is going to be paying your benefit for the rest of your life. Now, the FRS investment plan, on the other hand, is a defined contribution plan. And what that means is that the contributions that you make and part of the employer contributions that your employer makes on your behalf go into your FRS investment plan account, into the investment vehicle that you selected under that plan. And when you retire under the FRS investment plan, the balance of your FRS investment plan account are your retirement monies, and then it's up to you to determine how you're going to make those monies last you for the rest of your life. While under the FRS pension plan, you are guaranteed a monthly benefit for the rest of your life. Okay, that's the big difference between the two plans. So if you're contemplating switching, please call the FRS guidance line. So when the FRS investment plan was created, the legislature gave the responsibility of that plan to the Florida State Board of Administration, who hired a third-party administrator to handle that plan for them, while the FRS pension plan has always been administered by the Division of Retirement of the Department of Management Services. So we have two different state entities handling the two different plans. So if you're a pension plan member, you're going to go to the Division of Retirement's website, which is www.frs.myflorida.com, because everything on that website is applicable to you as an FRS pension plan member. However, there is another website out there, and it's called myfrs.com. And that website is the cooperative website between the Division of Retirement and the State Board of Administration. And everything that's on the Division of Retirement's website is also on that website, but there's a lot of investment plan information out there. Now, when the legislature gave the responsibility of the investment plan, or created the investment plan, they thought it would be a good idea to have an educational component to the plan. So they gave that responsibility to the State Board of Administration, who hired a private company called EY, or Ernst & Young, previously known as, to administer the FRS guidance program, okay? So that's the number that you call. So if you call that 866-446-9377 number, they can help you with plan choice, but also they can help you with any type of financial guidance that you need. For example, if you wanted to put together a plan where you are now and where you need to be in the future, they can help you do that and tell you what you need to do in order to get there. If you went to a private financial advisor, there is going to be a fee or a cost to what they do for you. Here, as an FRS member, you have the ability to have access to the free financial planning services of the FRS guidance line by calling that number, okay? So again, that other website is myfrs.com. There's a lot of good information on that website, and I implore you to check that out. On our website, I'll show you later on in this presentation how you can navigate to that website. So bottom line is that I'm through talking about the investment plan, and I am not going to talk anymore about that. I work for the Division of Retirement. The Division of Retirement administers the FRS pension plan, so I'm only going to talk to you about the pension plan. Obviously, to be vested under the pension plan, you have to, in order to be eligible for a future benefit under the plan, you have to be vested. And I'm sure most of you in this room are vested because you are approaching your normal retirement. But vesting just means the years of service that you need in order to be eligible for a future benefit under the plan. When the plan was first created, prior to July 1st to 2001, the vesting provisions were either 7, 8, or 10 years, depending upon which membership class you participated in. And then what happened is the legislature passed a bill that went into effect on July 1st, 2001 that changed the vesting provisions to 6 years worth of service. So if you were previously employed under the old vesting provisions and actively employed on July 1st, 2001, when the 6-year vesting provisions went into effect, you automatically fell under the 6-year vesting provisions. However, if you were previously enrolled under the old provisions and you weren't actively employed on the date when the 6-year vesting provisions went into effect, and you were more than a year away from vesting, you would have to come back to work for 1 year in order to fall under the 6-year vesting. Anybody that's initially enrolled on or after July 1st, 2011 is subject to 8-year vesting. And while we're at this point, do we have anybody in this room that was initially enrolled or initially employed in an FRS credible position on or after July 1st, 2011? Okay, if so, you were. Okay, that's fine. A couple people were. Okay, awesome. Okay, so the most important thing that every single one of you in this room need to know is what is and when is your normal retirement date. And why is this important? Because your normal retirement date is the point at which you're first eligible to receive an unreduced benefit, and it's also the point at which you're first eligible to enter into drop. So everyone should know what their normal retirement date is. So the easiest way to do this is to contact the Division of Retirement and ask them for an estimate at normal retirement so you know exactly when your normal retirement date would be. All right? So when is your normal retirement date? If you were initially enrolled prior to July 1st, 2011, which I'll refer to as a Tier 1 member, okay, your normal retirement date is when you are vested in age 62 or 30 years worth of service, whichever occurs first, okay? For members enrolled on or after July 1st, 2011, for them, it's when they're vested and or in age 65 or 33 years worth of service. So if you, in the bottom example, if you turned age 65, okay, and you did not have the 8 years worth of service to vest, it would be the first of the month after you have obtained the number of years of service to vest. Is this making sense? Everybody following me on that? Okay. All right. So if you're reaching your normal retirement date by age, okay, your normal retirement date is the first of the month you turn that age. For example, I turned age 62 on December 2nd, but I entered into drop on the 1st of December because I reached my normal retirement date on December 1st, okay? So if you're reaching your normal retirement date by years of service, then it is going to be the first of the month following the month you attain those years of service. Service retirement dates and drop begin dates always occur on the first of the month. A lot of people will say, well, my 30 years is on January 15th. No, it's not. It may be with your employer, but your employer reports salary to the division once a month, and when salary is reported, you get service credit for that month. Okay, so that's why service retirement dates and drop begin dates always occur on the first of the month. So as I told you before, you're eligible to enter drop at your normal retirement date. But if you're K through 12 instructional personnel, K through 12, not pre-K, but K through 12 instructional personnel, you can go into drop at your normal retirement date or at any time after reaching your normal retirement date and still participate in drop for a full 60 months. Okay, but if you're not K through 12 instructional personnel, like me, for example, okay, bottom line is, unless I'm eligible to defer my drop entry date, and I'll talk about those people in a moment, I would have to enter drop at my normal retirement date in order to be able to participate in drop for a full 60 months, because my drop participation period beginning at my normal retirement date and ends 60 months later. Now, I do have a 12-month window of election to participate in drop, which commences at my normal retirement date, but for each month I delay my entry into drop, I lose an equivalent amount of months of drop participation. So bottom line is, if I were eligible to go into drop on January 1st, okay, and I decided, no, I'm going to go in February 1st, okay, if I went in February 1st, I'm only going to be able to participate in drop for 59 months, okay? So bottom line is, if you make an election within the first 12 calendar months from your normal retirement date, you can elect to go into drop prospectively at any point within that 60-month drop participation window. But remember, your amount of months of drop participation are going to be lessened, okay? If you don't make that election within that 12-month window, then you lose your opportunity to enter into drop, okay? All right, so let's talk about the people that can defer their drop entry, okay? Like I said, K through 12 instructional personnel can go in at any time. But if the people that can defer their drop entry are usually those people who have reached their normal retirement date by years of service at a very young age. So if, for example, you were initially hired prior to July 1st, 2001, and you got your 30 years worth of service prior to age 57, you could go into drop at your 30 years worth of service, or you could defer your entry into drop up until the month in which you turn age 57. Then that would be your last opportunity to enter into drop and be able to participate for a full 60 months. And it's also at that point where that 12-month window of election would commence for you. Okay? Make sense? Everybody follow me? Okay. Awesome. And then, of course, for Tier 2 people, drop is a long way off. Those Tier 2 people are those who are initially enrolled on or after July 1st, 2011. If you reach your 33 years worth of service prior to age 60, then you can defer your entry into drop up until any month up until the month in which you turn age 60. Then that would be your last opportunity to enter and drop and participate for a full 60 months. And it's also there where that 12-month window of election would occur for you. So everybody's very confused about what drop is, and drop is very, very simple, okay? What it is this: when you go into drop, you are retiring when you go into drop. Your benefit is calculated, and what is happening when you go into drop, the years of service and the salaries that you earn while you're in drop have no effect on your retirement benefit, because your retirement benefit was calculated when you went into drop. And what happens is, each month that you participate in drop, your retirement benefit in pre-tax dollars is going over into your drop account each month. So if you went into drop and you participated for a full 60 months, this is a great way to have accumulated up to 60 months worth of retirement benefits on a tax-deferred basis while still earning a paycheck. So that's the advantage of entering into drop. While you're in drop, once you're in drop, you're no longer subject to paying the 3% employee contributions, okay? Because retirees don't pay the 3% contributions, and you retired when you entered into drop, so you don't have to pay them. And a lot of people will, increase their deferred comp or their 457 or their BenCor and add that additional 3% to their accounts while they're retiring because they're not going to miss it anyway. Okay, so while your monthly retirement benefits are accruing each month, you're also earning interest on your drop money. The effective annual yield on that is 1.3%. And also, while your monies are in drop, okay, you get a cost of living adjustment on your retirement benefit if you were initially enrolled prior to July 1st, 2011 and eligible for a cost of living adjustment. While your monies are accumulating in drop, you get a cost of living adjustment on your benefit each July, okay, just like a retiree does. All right, so what happens when your drop termination date is approaching? You've entered drop, you're getting ready to come out, okay, about 3 months prior to your drop termination date, you're going to get a drop termination packet from the Division of Retirement. And in that packet, there are going to be a couple forms. The first form is going to be the DP term form. And the second, and that's the form that you're going to complete and your employer is going to complete that says, yes, I'm terminating my drop. Okay, or terminating my drop on such and such a date, my employment will end. And the second form is the DP-PAYT form, or drop payout method form. This is the form that you will need to complete and return to the division to tell us what do you want the division to do with the 60 months worth of retirement benefits that have accrued in your drop account on a tax-deferred basis. And you have a couple options. You can say, I want the check made out to me, and I'm going to take a lump sum distribution of my drop monies, okay? But if you do that, the division has to withhold 20% for the IRS, okay? You may be subject to additional taxes because you had earned income that may change your income tax bracket. So maybe taking the lump sum distribution is maybe not the right thing for you to do. Okay, so the second alternative that you have is to do a direct rollover to another tax-deferred investment vehicle, like your BenCor account. The FRS investment plan also offers a vehicle to transfer it to as well, or to any other tax-eligible or tax-deferred plan that you may have. Or the third alternative is to do a combination of both, a partial lump sum distribution because you want to take that Alaskan cruise or you want to buy that new car, and then roll over the remainder of the monies into another tax-deferred investment vehicle. Now, you get this form 3 months prior. You should get it back to the division by the end of your drop-in date, okay, by your drop-in date. Okay, if you don't get that form back to us within the 60 days following your drop termination date, guess what's going to happen? The division is going to make a decision for you, and the decision is we're going to give you a lump sum payout. We're going to withhold the 20%, and you could be subject to additional taxes, okay? So if that's not what you want to happen, then, certainly make sure you get that form back to the division timely, okay? All right, so now that you understand that when you go into drop, you are retiring, okay? Just like a service retirement, except you're allowed to continue to work, your benefit is based upon the benefit formula. And the benefit formula, as I mentioned before, is your years of service times the accrual value that you get for each year of service times your average final compensation. And when we work that formula out, that gives us your gross option 1 retirement benefit, annual benefit. And gross because it's taxable. Okay, and your option 1 benefit, okay, is the benefit that you get for the rest of your lifetime. Okay, so bottom line, there are 3 other benefit payment options that you may be able to choose from, but they're all based upon the option 1 benefit, so we need to calculate that first. All right, so we got your gross option 1 benefit, annual benefit, and dividing it by 12 gives us your gross monthly option 1 benefit. All right. So let's break down the factors in that formula. Your years of service are all the years and parts of years of service that you were working for a participating FRS employer. Plus, it can be any optional service that you purchase if you're eligible to do so. So what are some of the optional service that you can purchase? Well, if you recollect, remember how I told you the system was when it was initially created, an employee contributory plan as it is now? Well, what happened was when a lot of people left employment, they took a refund of their employee contributions. And when one takes a refund of their employee contributions, what they are doing is they're giving up the years of service associated with those employee contributions. So if you're one of those individuals that did that, you can buy that service back, okay, and pay back those contributions, but you'll have to pay 6.5% per annum back to the year in which those contributions were associated with, okay? There's also leaves of absences. If you were on an unpaid leave of absence, like for example, in a maternity leave, you can buy up to 2 years worth of leave of absence that you had with an FRS participating employer. And what it is, you would have to return back to work immediately following that authorized leave of absence that was in writing, okay? So if you did that and you wanted to maybe find out how much it would cost to purchase that service, you would complete the FR28 form, which is found on the forms page of the Division of Retirement's website under the members page. Complete that form and then submit that form to that FRS participating employer for them to submit it to the Division of Retirement for us to calculate the cost and determine whether you're eligible to purchase the service. There are also other types of service that you can purchase under the in-state, out-of-state provisions. In-state service would be a service that you had in the state of Florida working for a public employer in the state of Florida that was not participating in the FRS, but in their own plan. You had to be participating in a retirement plan with that in-state employer. And it can also include service that you may have had with a charter school or other school in the state of Florida, as long as it was accredited by the Southern Association of Colleges and Schools. Also, out-of-state service would be out-of-state service that you may have had with an out-of-state public employer. It can also include military service that you had, as long as you did not get a military benefit based upon that military service. You would be eligible to possibly buy that military service, and all you'd have to do for the military service is submit a DT-214 and it can also include federal service. So if you have in-state or out-of-state service, okay, you would need to complete the FR30 form and then submit that form to that in-state or out-of-state public employer, who would complete the form, give it to the division, and then we would be able to determine whether you're eligible to purchase that service and provide you the cost. If it's military service, all you need to do is submit your DD-214. I'm going to tell you up front, the cost to purchase 1 year of out-of-state service is going to cost you 20% of your first year's salary under the FRS, plus 6.5%. For 1 year service, it's going to cost you 20% of your first year's salary under the FRS. Minimum salary being used in that calculation is $12,000. So it can be very, very expensive, plus 6.5% interest per annum. So there is on the division's website, there's an estimator there that provides you what the cost would be to purchase that service. But if you were going to purchase a service and you were eligible to purchase it, you can remit your personal remittance for it, or you can roll over monies from another tax-deferred plan, like your Bencor or from your IRA, to roll over from custodian to custodian or trustee to trustee the monies to the FRS to pay for that service. But it would have to be accompanied with the PRO-1 form that I've referenced here on this page. So let's talk about the next component in the formula. We've talked about the years of service, so let's talk about the accrual value that you get for each year of service. If you retire, if you're initially enrolled prior to July 1st, 2011, okay, if you retire up through age 62 or up through 30 years worth of service, the accrual value that you get for each year of service is 1.60% for each year. If you retire at age 63 or 31, the accrual value then goes up to 1.63% for each year of service, and then at 64 and 32, it goes up to, or 32 years of service, it goes up to 1.65, and then at age 65 and 33 years worth of service, it maxes out at 1.68. And if we have anybody in the room that's senior management, they just get a flat 2% accrual value for each year of service. For those of you that were initially enrolled in an FRS position on or after July 1st, 2011, the accrual values in the regular class are exactly the same, but the age and the years of service are different, okay? And then senior management service, the accrual value still remains 2%. So the other thing that we need to talk about, the final factor in the formula, is your average final compensation. So if you were initially enrolled in the FRS prior to July 1st, 2011, it's the average of your highest 5 fiscal years worth of salary, okay? If you were initially enrolled in the FRS on or after July 1st, 2011, it's the average of your highest 8 fiscal years of salary. Okay, now some of you are K through 12 instructional personnel, and some of you are in other positions, 12-month positions. And so usually instructional personnel don't get paid annual leave. Okay, so if you're in a 12-month position that accrues annual leave, okay, the statute allows you to get a lump sum payout of up to 500 hours of annual leave at the time that you retire or at the time that you enter into drop, subject to agency limitations. And if it is in your highest years, this can impact your average final compensation, okay? So if you say your last year's salary was your highest year's salary and you were making $40,000, okay, in your last fiscal year, and you had a $10,000 annual leave payout, that means that then your average final compensation or your average, your final fiscal year salary would then be $50,000 because it includes the payout of your annual leave. Does that make sense to you? Sick leave is not reportable to the division, and the payout of your sick leave does not impact your retirement benefit. Okay? For those of you who also, they're 12-month employees, if you earn any special comp time, instead of getting a time and a half paid to you, you accumulate accrued comp time within the last 11 months prior to retiring or entering in a drop. That can also be included in your average final compensation calculation. All right, so some people are thinking, well, I'm not reaching my normal retirement date, okay, at the end of the fiscal year, okay? I'm reaching my normal retirement date, say January 1st, 2018, okay? So that's in the middle of the fiscal year. So if you're a 12-month employee, okay, you know, you're going to probably ask, well, what about my salaries that I've earned this fiscal year, which are not, is not a full fiscal year? Well, if it's your highest paid fiscal year, more than likely those salaries will be included in the calculation. In this example here, this person is retiring January 1st, 2018. He's a 12-month employee, and he's going into drop January 1st. So he's got 6 months or 6 months of a year or half a year's service credit, and the salary that he earned is $15,000 in that 6 months. So we take a look at that salary that was earned in that half a year, and we annualize the salary. In other words, we take the $15,000 divided by the half a year service credit, and therefore annualize it. And we see that $30,000 if he had been worked the entire year is what he would have been paid, and that is higher than all the other fiscal years. So we are going to use, in this case, the $15,000 that they earned in that half a year in the average final compensation. Then we're going to go back to the next highest year, which is 17. We're going to use that full year. We're going to go back to that next year, the next year, the next year. So now we've got 4.5 years worth of service. So in this case, we're going to go back to the prior or the 6th fiscal year, and we're going to determine what his the half a year of salary would have been. So we're going to take his full salary for that year was $25,000. Okay, and then we multiply it times the 0.50 or the service credit needed, and therefore we're going to use $12,500 worth of those salaries in that 6th fiscal year to come up with a total of 5 years worth of service. So there will always be a full 5 years worth of salaries included in your average final compensation. And so that means the total of this person's salaries are $137,500 divided by 5. This means that this person's average final compensation is $27,500. Does that make sense to you guys? Okay. So here's just now that we've got all the components of the formula together, let's just put it together. We've got here a person at normal retirement by years of service, 30 years worth of service. Their accrual value is 1.60 for each year of service. For simplicity's sake, we're going to say their average final compensation is $25,000. That gives us a gross option 1 benefit of $12,000, and dividing it by 12 gives us a monthly gross option 1 benefit of $1,000. So, you know, you can always retire before you reach your normal retirement date. And we all get there where we say, you know, I'm done, I'm through. I don't care, okay? So we've had moments like that. So if you decide that you're moving or you're done, and you want to retire, you can take your retirement benefit early. But if you do take your retirement benefit early, your benefit is going to be reduced by 5% for each year that you were under normal retirement age. So it doesn't matter if you have 29.75 years worth of service, and if you're 61 years of age, you're still going to be subject, if you're a Tier 1 member, you're still going to be subject to that 5% reduction in your benefit. So if your benefit was $1,000, okay, and you took a 5% reduction in your benefit at 61, okay, then your benefit is only going to be $950, and it's a, you know, it's a reduced benefit for your lifetime. But it may be to your benefit to take the benefit early, because if you're taking the benefit early by a year, that's, you know, $950 a month for 12 months that you have in your pocket, plus, you know, you're eligible for the health insurance subsidy benefit if you're maintaining, you know, health insurance after you retire, which gives you an extra $5 per month for each year of service that you have, up to a maximum of, you know, 30 years, or an extra $150, you know, each month. So it may be to your benefit. And once you start drawing your benefit, you're also going to get the cost of living adjustment. So if you're contemplating retiring early and you're undecided whether you want to take the benefit early or wait till you're age 62, then call the FRS guidance line and speak to an EY counselor, and they can help you walk through whether you want to take the benefit early or not. Okay? So that's how it is. So if you're like 61 and a half years old, okay, when you retire early, okay, you're only going to get a pro rata reduction of that 5%. So if you're 6 months away from your normal retirement age, then your benefit's only going to be reduced by 2.5%. All right? Okay. So, yes, ma'am. Okay, let me straighten out. Her question is, if she retires in the middle of the month, okay, you're still going to get a full month's service credit for that month, okay? Because it doesn't, as long as you're paid in a month, you get service credit for that month. It doesn't matter, as long as you worked one day in that month, you will get, and paid in that month, you will get service credit for that month, okay? Okay. Okay, your service credit is awarded when it is paid. Okay, the question is, if when you get service credit or you get paid, that's when you get service credit. Okay. Right. Okay, you probably would want to maybe talk to her about that in a little more detail because she's more involved with HR. So that's one of the questions I'll defer to her on. Okay, all right. So, and it's not that I'm avoiding your question. I want the answer to come from your HR department. Now, one of the most critical decisions that you're going to have to make when you retire is to select your benefit payment option. And it's really important that you select the proper benefit payment option. And the reason is this. After your first retirement check has been cashed or deposited, or after your first month of drop participation, you cannot change your benefit payment option. That's in statute. Okay, so you could call me and cry me a storm, and I would be very empathetic. But bottom line is, I don't have the ability to let you change your benefit payment option because it is in statute, and I'm required to follow statute, and I cannot break the law for you as much as I understand. So know what benefit payment option you're going to select. So. Option one, like I told you, there are 4 benefit payment options. Option 1, okay, is the benefit payable to you for your lifetime. Once you pass away, there is no ongoing benefit to anyone, okay? Under option 1 and option 2, you can name anyone as your beneficiary. And you would say, well, why under option 1 would I need to name a beneficiary? Well, you do if you're going to go into drop because your monthly benefits are accruing in drop, and we need to know who your beneficiary is going to be in case you pass away while you're participating in drop. We're not going to allow you to go into drop unless you've designated a beneficiary. But if you're doing a straight service retirement, remember this, that you have been paying employee contributions into the system for a number of years now. Okay, if you draw your first benefit check, or you got your first benefit check and you run to the bank so excited to get that check, and you run in the bank, you cash that check, put the money in your pocket, and you run across the street without looking, a car comes and that's it. You're done, okay? All right, if the benefit that we have paid you has not exceeded the contributions that you've made, then we need to refund your beneficiary the contributions that have exceeded, that remain on deposit. Does that make sense to you? So everyone should be designating a beneficiary. In fact, if you're not in drop and you're not retired yet, every one of you should have logged into your FRS online account and designated your beneficiary in case you pass away while you're working. Who's going to get your money? Of course, it's by law, first to your spouse, then to your children, then to your parents, and then to your estate. But we don't know that, okay? So we're going to have to wait until all that documentation comes in. So if you've designated your spouse on your FRS online account, we know who your spouse is, and you've designated her as a beneficiary, and so the process will be a lot less cumbersome for her or him. Okay, so option 1 and 2, you can name anyone as your beneficiary. Now, option 3 and 4, you can only have an option 3 or 4 if you have somebody that is the beneficiary that is a qualified joint annuitant. And who's a qualified joint annuitant? Your spouse, okay, your children under the age of 25, unless they're physically and mentally disabled and incapable of self-support, then beyond 25, a parent or another person for whom you're the legal guardian of, as long as you've claimed them as a dependent on your income tax. So bottom line is, those are the only people that would qualify as a joint annuitant. So if you don't have one of those individuals as a beneficiary, if you still want option 3 or 4, then you're not eligible to select an option 3 or 4. Does that follow me on that? Okay. So let's talk about the benefit payment options. Okay, we explained option 1. And basically, all the other 3 benefit payment options are actuarially equivalent to the benefit payment stream that you would receive over your lifetime under option 1. Okay, so based on life expectancy tables. So if you're selecting option 2, this is what you were saying, is that I'm going to take a reduced monthly benefit for the rest of my life and select option 2. And if I should die within 10 years of my service retirement date or within 10 years of my drop entry date, okay, then my designated beneficiary will receive the remaining payments due me during that 10-year time frame, and then the benefit payment will then cease. So if you've gone into drop and you've completed drop, remember the 10-year time frame commenced at the time that you entered into drop. So by the time you come out of drop, if you're participating for the full 5 years, there are only 5 years remaining in that 10-year time frame. But it's a reduced monthly benefit for your lifetime. All right. So we talked about the joint annuitants. I forgot I had added the slide because you guys are the first ones I do every year, starting out my travel to the different schools and stuff like that. So these are the people that are qualified for it to be a joint annuitant. Okay, so let's talk about option 3. Option 3, except when it applies to a child, this is how option 3 works. Okay, if you select option 3, what you are saying is, I'm going to take a reduced monthly benefit for the rest of my lifetime based upon my age at the time that I retired and the age of my joint annuitant at the time that I retired and his or her life expectancy. Okay, so basically, you've taken the option 3. You're taking the reduced monthly benefit for your lifetime. If you pass away, okay, then your joint annuitant will continue to receive that same benefit for their lifetime. Does that make sense to everybody? Follow me on that? Okay, except when it's a child. Okay, if you name your child as your beneficiary, okay, and you select option 3, okay, what you were saying, yes, I'm going to take the reduced monthly benefit for my lifetime. If you pass away, okay, and your child is under the age of 25 at the time that you pass away, then your child will receive your option 1 benefit for up until the age of 25. Even though you selected option 3, the child's going to receive the option 1 benefit up to age 25, and then the benefit will cease for your child, unless that child is physically and mentally disabled and incapable of self-support, then that child will continue to receive the option 1 benefit for the remainder of their life for as long as they remain physically and mentally disabled and incapable of self-support. Okay? Everybody follow me on that? Okay. So option 4, okay, can be really enticing to purchase or to select. And the reason is because the option 4 benefit initially, okay, will always be higher than the option 3 benefit, okay? And if your joint annuitant is somebody who's really, really old and their life expectancy is really, really short, conceivably your option 4 benefit can be higher than your option 1 benefit initially. Okay, but what happens is when you select option 4 benefit, you're taking this adjusted monthly benefit And if either one of you pass away, whether it's you as the member or your joint annuitant, the survivor, whether it's you or your joint annuitant, their benefit to the survivor will be reduced to 2/3 of what you were getting while both of you were alive. Okay? So this is the danger of selecting the option 4. Now, people may select it because they are, have life insurance policies on each other that would, and they have longevity on their life. They're playing their odds, and that's fine, but that choice is there. But understand that you're running that risk if you select the option 4 benefit. Now, if you're naming a child under option 4, okay, and you've named your child as your beneficiary, and you pass away, okay, then your benefit, okay, even though if the child's under the age of 25 when you pass away, even though you selected option 4, that child is going to receive your option 1 benefit up until the age of 25, and then it will cease. And then again, if that child is physically and mentally disabled and incapable of self-support, then that child will continue to receive the option 1 benefit for as long as they remain so, okay? So that's how it works. Now, if you've named a child under option 4 and your child predeceases you, then that's going to be a problem. You know what's going to happen to your benefit as a survivor? It's going to be reduced to 2/3 of what you were getting while both of you are alive. So just be aware of that. If you pass away while you're in drop, okay, that's going to change your drop accrual, okay, because someone passed away while you're in drop. So just be aware that that can happen. So if you don't know what benefit payment option to select, don't submit your benefit payment option right away. If you haven't gotten an estimate of benefits and you just put option 3 and you don't know what your option 3 benefit is, don't submit that form until you know. And if you don't know what benefit payment option you want to select, that's a perfect call for the FRS guidance line to help you work through that process. The Division of Retirement will not advise you on that. That's up to you, but EY, their financial planners, they can assist you with that decision. So is everybody clear on the benefit payment options and how they work? This is all in the FRS member handbook, okay? So bottom line is, once you're retired or once you go into drop, only the Tier 1 members, those are the members that are initially enrolled prior to July 1st, 2011, are eligible for cost of living adjustment. And that's because the legislature passed a bill that went into effect on July 1st, 2011, that said any service that we earn on or after July 1st, 2011 is not eligible for a cost of living adjustment. But all our service earned prior to that is. So when you retire or you go into drop, we have to calculate what your cost of living adjustment is going to be. So how do we do this? We take your years of service that's eligible for the cost of living adjustment, meaning all your service earned prior to July 1st, 2011, and then divide it by the total years of service that you have at the time that you retire or at the time that you enter into drop. And then we multiply it by 3%. So the bottom 2 examples are just examples. You could have 26 years of service eligible for a cost of living adjustment and have a total of 38 years worth of service. There's no limitation on the years, okay, or partial years. That's why I provided those examples there. Okay, Tier 2 members, again, are not eligible for cost of living adjustment. Now, there is a bill out there this legislative session, we're in legislative session right now, that proposes to put a minimum on the cost of living adjustment at 2%, because I just entered a drop and my cost of living adjustment is like 2.014 or something like that. And everybody's going to be different based upon that formula. I don't know how that bill is going to turn out, but I just wanted you to be aware of it. They apparently haven't requested an actuarial special study, so it may or may not happen, but you can keep abreast of this on the Division of Retirement's website, and you can also, if you felt compelled to do so, reach out to your legislator if you're one of those people that are impacted by the cost of living adjustment. Because the further out you go, in other words, the more years of service that you have, beyond July 1st, 2011, the bigger the denominator in that equation gets and the lower your cost of living adjustment gets. So those of you who are eligible to go into drop at a very young age or thinking about deferring your drop entry, yes, the benefit formula, your years of service is going up. Your accrual value of, for each year of service may be going up, and so may your average final compensation, okay? But just keep in mind that your cost of living adjustment is getting lower. But I'm not saying that you should do one or the other, but these are things that you can look at. And if you've accessed your FRS online account and you're one of those people that has the ability to defer your drop entry, you should be going online after you have gotten an official estimate from the division and going into your FRS online account and doing some of your own calculations as well on your account. Okay, so applying for service retirement, we encourage everybody to apply ahead of time. Okay, and the reason why we encourage you to apply ahead of time, up to 6 months prior, we'll accept your service retirement application. And the reason for this is if there's anything missing, we want to get you on retired payroll timely and give you time to get your stuff together. So, but by you attending, you're going to get all your stuff together for service retirement or drop and have everything prepared, and she'll make sure you have everything because Vicki does a great job in preparing everybody. She walks you through the process. But you can apply for service retirement up to 6 months prior. The form is the FR11 form, which is the application itself. If you terminated your employment today in the middle of the month, okay, that would make you eligible for a terminated day. This would make you eligible for a February 1st effective retirement date. Okay, you have 30 days to get your application to the division in order to be able to retain that February 1st effective retirement date. If your application is not received by the division within 30 days of your termination date, then you lose your eligibility to retain that February 1st effective retirement date, and your application will be effective the first of the month following the receipt of the application. So if we got the application late, okay, and you became eligible for a March 1st date when you could have had a February 1st date, and your benefit was $1,000 a month, you just lost $1,000. Okay, so that's nothing to sneeze at. You wouldn't want to lose $1,000 because we don't give you that benefit retroactive. Your retirement is effective, the first of the month following the receipt of the application if it is not received within 30 days of your termination date. And of course, we encourage you to apply ahead of time. As far as drop is concerned, okay, as you know, drop begin dates, like service retirement dates, always begin on the first of the month. You should be applying up to 6 months prior. Don't panic. You don't have to have it 6 months prior, but you will accept it that early. The application is the DP11 form, and the DPELE form is your notice of election to participate in drop and is also your resignation of employment, with your employer. So if you're signing up for drop and you say, oh, I'm only going to be in for 2, maybe 3 years, and then I'm going to terminate. So I'm only going to sign up for 3 years. Well, a lot can transpire in a 3-year time frame, and you may get to that 3-year time frame and say, oh, no, I can't retire. I need to work. I forgot to think about how much the premium is for my health insurance, and I'm not Medicare age. And believe me, I've checked this all out. It's a lot. So bottom line is, my suggestion is if you're going to go into drop and you're not sure whether you're going to participate the whole time, sign up for the full period of time, okay? And if you decide you want to terminate early, then you need to immediately advise, Vicki, and you need to immediately notify the division as soon as you possibly know that you're going to be terminating early, as much in advance, so that we can get you out that drop termination paperwork, okay? But that's up to you. That's just one thing that I would do and my place there. Okay, so if you don't sign up for the full period of time and you get to that point, that 3-year time frame, then you're going to have to go and visit Vicki, and you're going to say, would you rescind my resignation, allow me to participate in drop for the full 60 months? And she may have instructions to say, no, you can't extend, we can't, that's your termination date. Okay, and there's nothing you can do about it because you signed your resignation when you went into drop. So make sure you do the thing that's most advantageous to you. Okay, the other items that you need to complete your application and your drop application, service or drop, is the FRS 11-0 form. That's your option selection form. So each and every one of you will have gotten your estimate already, and you already know what option you're going to select, right? So then you would complete that form when you sit down with Vicki, okay, or one of her associates there, and make your option selection. You'll also need to complete the form SA-1, which is a spousal acknowledgement form. This is the form that you need to tell us whether you're married or not. Okay, and if you are married and you're selecting option 1 or 2, in other words, precluding your spouse from an ongoing benefit by selecting option 3 or 4, statute requires that your spouse acknowledge that you are selecting option 1 or 2. Okay, that's what statute says. Okay, so we do have to follow that. That isn't a policy decision. Okay, but this is your retirement benefit. You worked for it, so you select the option that's best for you. Okay, all right. The other thing that you're going to need to provide is proof of birth. Your benefit is based upon your age at the time of your retired and your life expectancy. In order to actuarially properly fund the FRS, it's all based upon life expectancy tables. We need to have your proof of birth, okay, because your benefit is based upon that. So proof of birth would be your birth certificate from, the state or governmental entity that has recorded your birth certificate. It's not the hospital birth certificate that you get with a cute little feet print on them, okay? That's not registered with the state. It has to be the one registered with the state or other governmental entity. Okay, if you're a non-resident alien, your certificate of naturalization could do. We will also accept your Florida driver's license if it was issued in accordance with the Federal Real ID Act. And how do you tell if your driver's license was issued in accordance with the Federal Real ID Act? If you look at the face of your license, up near the image of the state of Florida, you're going to see a gold star. That means that when you went to apply for your driver's license, you showed them proof of birth, okay, and therefore they issued that with you. If you do submit it in, you're going to bring it in with her and let her send it in for you, because if it isn't properly sent in, it's very difficult to read, because when any work comes into the division, we never see the original documents. So don't ever send us any original passports or driver's license, or you would be amazed the things that do, because it's scanned right into the workflow process. So if you've sent us a bad copy and it's further degraded when it comes in, we're gonna have to ask you for another copy. If you're selecting option 3 or 4, you're gonna have to provide proof of birth for your spouse as well. Okay, so make sure you've got your spouse's proof of birth there on there. Did you have a question, sir? Oh, okay. Well, if he was asking if his birth certificate had to be from the state, come from the state, or whether he could photocopy his original birth certificate that was issued by the state. Yes, we don't want your original birth certificate. If you have your original birth certificate that was issued to you, okay, that was issued by the state of Florida or is registered with the state of Florida, then we only want a photocopy of it, okay? So when you go and visit Vicki, you can bring in either a copy of your birth certificate or the original birth certificate, and that's fine. Valid U.S. passport will suffice as proof of birth anyway. And for anybody who likes to travel, you're going to need your Federal Real ID, identity card or driver's license or passport in order to travel sometime soon. So everybody should be getting their license or their passport issued so they can fly as well. Okay. The other thing is, if you're selecting option 3 or 4, okay, you have to provide us a copy of your recorded marriage certificate if you're designating your spouse as your joint annuitant, okay? So this is not your marriage certificate signed by the priest or the rabbi or the notary, okay? or whoever officiated the ceremony, this is the one that is registered with the clerk of courts or with the state or other governmental agencies. So you'll want to be getting that prepared when you submit your retirement paperwork so that your retirement will go smoothly. Okay, so all these forms Vicki will help you with, correct? Okay, she walks you through it. She does it 1,000,000 times, or probably has pretty close to that. So she knows how to fill out these forms properly. So you don't really need to pull them up. She'll pull them up for you, but I just wanted to be let you see what the forms are and all the instructions are there. But if you go to the Division of Retirement's website, you click on the members page, and then go to forms, okay? The first two items in the forms packet are the drop retirement forms and the service retirement packet of forms. Those are all the forms that you need to complete your retirement application, but you guys don't have to do that because Vicki will pull up all the forms for you. Yes, ma'am? Yeah? Okay. We're backtracking here a little bit, and I'll answer this question, is this. Option 1 is based upon the benefit formula. The reductions or the calculation of the other 3 benefit payment options that you can select. If you select option 1, for example, based upon your age at the time of your retirement and your life expectancy, you're going to receive a benefit payment stream over that entire period of time, okay? If you're selecting option 2, okay, it's a reduced monthly benefit based upon your life expectancy and the probability of you surviving beyond 10 years. But under option 3 or 4, the reductions or the benefit is based upon your age at the time that you retire and the age of your joint annuitant and your joint life expectancy. So it's an actuarial calculation. So that will equal what you would have received under option 1. So I can't explain it any better than that if that helps a little bit for you. Okay. All right, so when you retire, right when you terminate your employment, if it's a service retirement, and right before you get your first retirement benefit check in the mail, you're going to get a retiree packet. If you're a drop participant, okay, you terminate drop, and right before you get your first benefit check at home, you're going to get a retiree packet in the mail. And in that retiree packet, there are going to be several different items. The first one is the form W4P, which is the form that you need to complete to tell us how many withholding allowances you want taken out of your benefit for tax purposes, okay? Because benefits are taxable. The second form is the Department of Financial Services form, which is the state agency that issues all the benefit checks for the Division of Retirement, is the direct deposit form. Everybody is required to sign up for direct deposit. So that's the form that you would need to complete, providing us with your account number and your bank routing number to sign up for direct deposit. However, if you're doing service retirement and when you submit your service retirement application, we send you an acknowledgement in the mail that says, we've got this, your retirement effective this date. Here are all the things that are missing, or maybe nothing's missing, but we acknowledge your application. When you get that acknowledgement of your application, that means that you can log into your FRS online account, fill out your W4P on your FRS online account automatically, and sign up for direct deposit on your FRS online account without having to submit those forms, okay? So just be aware that if you're going into drop, okay, and when you get your drop termination packet in the mail, okay, right before your first, that's when you can log into your FRS online account and set up the withholding for your taxes and sign up for direct deposit, okay? Otherwise, you'd have to mail those forms in. The Department of Financial Services form has to be mailed with a good copy of your driver's license directly to the Department of Financial Services, not to the Division of Retirement. Okay? And it can't be faxed to them either. The other form is the HIS form, and this is the form that if you complete and you're maintaining health insurance after you retire, okay, you can apply for the health insurance subsidy benefit. Okay, so what the health insurance subsidy benefit is this. If you're maintaining health insurance after you retire, you can get an extra $5 per month for each year of service that you had, up to a maximum of 30 years worth of service. So that is up to the years of service at the time that you retired or entered into drop. So you can get up to a maximum of extra $50 a month added to your retirement benefit check. If you get that form back to us within 6 months of your service retirement date or within 6 months of your drop termination date, we'll give you that benefit retroactive to your first benefit check at home. Okay, so if you wait longer, then we're only going to give it to you retroactively by 6 months. You look like you have a question. You all right with that? Okay, great. All right. So, yes, ma'am. Yes. Okay. Well, basically, let me say what her question is this. She's asking, I told everybody in the room that you can apply for drop up to 6 months before. You need to go through Vicki Seitz, okay, for her to help you with the paperwork. Okay, we do not send you any applications. We don't know when someone is going to retire. It's up to you as the member to apply for retirement. We have people working in their 90s, okay, still working, and they haven't terminated their employment and they haven't retired. A lot of people terminated their employment when they were 50 and haven't applied for retirement. They're waiting to their age 62. We try to reach out to them, but bottom line is it's always up to you to apply. We don't send you the forms. There are over 600,000 members in the FRS that are working. There are over 1,100 or almost 1,200 FRS participating employers throughout the state. So I'm going to pass on that because we got a Q&A session after that, and I'll get back to you on that. Okay. So let's talk about reemployment after retirement. Okay. All right. So bottom line is, in the first 12 calendar months of your service retirement, or in the first 12 calendar months following your termination date from drop, that is known as the termination and reemployment limitation period. In the first 6 calendar months of your service retirement, or in the first 6 calendar months following your termination date for drop, you cannot work for any FRS participating employer in any capacity, because if you do, you will void your retirement. And a lot of people will retire and they'll say, okay, you know what, I'm going to go work for, volunteer at the polls. Well, guess what? You can't volunteer at the polls. You're going to get paid to work at the polls, okay? And guess who is an FRS participating employer? The supervisors of elections. So be very careful about what you're doing. You cannot go back and work in a temporary position with any FRS participating employer, temporary or full-time, during that 6-month calendar period. Otherwise, you are going to avoid your drop. If you're contemplating coming back as a contractor, okay, you better be very careful about that. You'll have to contact the Division of Retirement's enrollment section, and they'll have to check out that contract to make sure that there is not an employee-employee relationship. Because if it's later found out that you violated the termination requirement in that 6-month period of time, you'll have to repay back any and all benefits you received. And if you were in drop, okay, and you had all your drop money, you're going to have to pay that back too, okay? So make sure you don't violate any, especially during the first 6 calendar months. In the subsequent 7th through 12th calendar months, statute says you can go back to work for an FRS participating employer, but during that time frame, but you can't simultaneously receive a retirement benefit and a salary from an FRS participating employer. So that means you have to suspend or forfeit any and repay, if any were paid to you, any of the benefits that you received during that time frame back to the FRS. So make sure that doesn't happen to you. Once that 12-month time frame has elapsed, okay, you can go back to work for any FRS participating employer in any capacity. I'm going to hold questions to the end if you don't mind. Would that be all right? Okay, because this is only being filmed, and that's why I want to get through it before we run out of time. And then we're going to address all the questions. So if you're going to suspend your payment, you need to advise Vicki. FR23 form is the form to stop it. And on the 13th month, it can be initiated again with the FR23A form. Renewed membership. Once you retire under the FRS pension plan, okay, you cannot participate in any state-administered retirement plan again. The state university system optional retirement plan, the community college optional retirement plan, or the FRS investment plan. Now, they're effective July 1st, 2017, retirees of the FRS investment plan became eligible for renewed membership under the FRS effective July 1st, 2017. But if you're a pension plan retiree, you're still ineligible for renewed membership under the FRS. I also hate to bring this up, but with respect to forfeiture of benefits, because all of you guys look like nice people, but basically if you're convicted of a crime, as outlined in section 121.091, parens 5 of the Florida statutes, or 112.3173, which are basically crimes against your employer, like using your position improperly, stealing or bribery and things like that. They're also outlined stealing or bribery from your employer. They're employer-related crimes. You will forfeit your benefit if you're convicted by a court or a competent jurisdiction of that crime. So this includes the time while you're in drop. So basically, sometimes people are desperate. They do desperate things, but wait till you're completely unemployed and out of drop and retired, okay? So here's the Division of Retirement's website, okay? You can get to the myfrs.com website via the icon on the right-hand side, and I encourage you to do so. But I do think that you should log into your FRS Online account. And you can do that by clicking on the FRS Online icon on the right-hand side of the page at the top. And by clicking on that, that takes you to the login page of FRS Online. If you've never logged into FRS Online, click where it says click here and start setting up your username and password for FRS Online, okay? Because when you retire, you're not going to get benefit payment stubs in the mail. The only way you're going to get them is by logging into your FRS Online account, and that's the only way you currently can get your member annual statements. But there are a lot of good features there. So once you get in, you're going to be required to enter in your MyFRS PIN, that 4-digit number that you got in that initial plan choice packet, and I'm sure everyone in this room knows where their MyFRS PIN is, right? Same place as mine. So don't panic. Start the process, and then it'll request you to enter your number or request a PIN. Request the PIN. It'll take about 10 days to get in the mail. When you get it, then log into your FRS Online account. If you attempted to log in and it says it doesn't recognize your social when you went in, okay, I'll put it in. That means that you probably already logged into your FRS Online account and you forgot your username and password. So click on the link that says forgot your username and password, so it will be set back to the defaults so that you can gain access to your account. All right, and just your username can be anything that you want to create. Passwords are case sensitive, so remember to write them down as you type them in. Okay, and then just log into your account. Everybody has the My Account modules. The profile settings is where you're going to keep your email address current with the division. I always suggest that you use your personal email address because when you retire, you won't be having your work email address anymore. Communication preferences, if you set it as electronic, any estimates that you request from the division, you'll be notified of it by email, and then you can log into your account to get it, and your inbox just has prior correspondence sent to you. As an active member, meaning you've not yet retired or not yet entered a drop, you can look at your history summary year by fiscal year to see, look at your history. Is it correct? Is there a year where you're missing service credit? And then you may say, I was on a leave of absence. I wonder if I can purchase that. Service history summary is just a summation of your total years of service as of the last payroll date. This is where you can designate your beneficiary as an active member. This is where you get your member annual statement. You can do a current estimate. If I terminate today, what will my benefit be effective the first of the month, the following month? Or create an estimate. Like I told some of those people that are eligible to defer their drop entry, you can create estimates for different dates. Once you go into drop, we send you that final drop accrual. About 3 months after you go into drop, you lost it, put it in the same place you put your My FRS pen. Don't worry, you can go into your account and look up your drop accrual. It's right there for you. If you selected option 1 or 2, okay, you can change your beneficiary. If you got mad at your friend and wanted to name somebody else, you can change your beneficiary under option 1 or 2. Once you retire or terminate drop, this changes to retiree services. The account information is where you can input your W-4P information. Change your direct deposit. Beneficiary you can change under option 1 or 2. Option 3 or 4, if you change a beneficiary, you can only do that twice in a lifetime. And if you change your beneficiary or your joint annuitant under option 3 or 4, that is also going to result in a change in your retirement benefit. Once you retire, it is up to you to keep your address current with the division, and then you can sign up for a direct deposit or change your direct deposit. Now, these are all the numbers to the division, our fax number, and our email address. And I know there are a couple questions out there, so do we still have time for questions? Okay, okay. Okay, all right. Oh, okay, we can do it at the end. Okay. Karen, come on up, I guess. Sorry. I'll get to your questions. Thank you. Oops, God, don't fall over on me.
That's all I need. Microphone. It's a curse. Thanks, Rich. He did a great job. Karen Cooley's going to come up. She's benefits. What do you do now? She's a benefits coordinator. She's going to talk to you about retiree benefits. She knows everything.
So benefits for, if you want to continue as a retiree, you may do so. The health insurance, you can continue. I think in your packet you should have the new rates. As you know, open enrollment starts next week. Rates did go up, so if you want to continue the medical insurance, you can do so. You would just need to complete the paperwork in order to get us in, and once you retire, you'll get a packet from us if you want to continue those benefits. The other benefits that you can continue re-retire is your dental, your vision. Those 3 benefits, basically we have it deducted from your FRS check if you have a regular pension. If you do not have enough in your paycheck or in your pension to have it deducted, we will bill you on a monthly basis. Or if you're in the investment plan, we will set you up through billing and you'll get a monthly billing from us. So either way, you can be able to continue. The other benefits that you have is like the cancer, the critical illness, and accident. Those policies you can continue, but you will actually go through Allstate directly to continue those benefits. The cancer insurance is convertible, which means you can convert it to an individual policy. It will not be the same benefit as it is, and the rates are based on an individual. The accident and the critical illness, those 2 benefits are portable, which means they'll be continued as the same plan. It will just be, you will be directly to or from Allstate directly. Life insurance. If you want to continue life insurance when you leave, you may do so. The amount is up to the max of $100,000. Keep in mind, on our website, if you ever go to leeschools.net/insurance, there's a section called Exiting Employee, and that gives you the information based on retirement. And for the life insurance, your life insurance amounts does reduce over a period of time by age, different age brackets. The max you can set aside is $100,000, or you can go less. So if you currently have more than $100,000 right now, you can't take the additional, only 100,000 or less. But the amount does reduce over a period of time by certain ages, and that breakdown is on our website for that. The other benefit that the disability insurance, that will end. You cannot continue that when you leave. So that is something that will just dissolve when you're no longer an active employee. Are there any particular questions you have, general questions about the medical or anything? Yes. COBRA does not apply. And the question is, when you terminate from the system or retire, if you received a Florida retirement pension, we offer you the same rate as an active employee, which means you don't pay additional fee and you don't have any limitations. Under COBRA, there is a 2% administrative fee, plus you can only keep the benefits for 18 months. So it's in your best interest to continue as a retiree to where you can, whatever the premium the district pays, we pass that same amount on to you with no additional fee, and you can keep that benefit for as long as you pay the premium. So it's more advantageous for you to continue as a retiree versus COBRA. Yes. At the time of retirement, you have to continue with that plan. So like during open enrollment, if you're planning to retire sometime this year, maybe the end of the school year or before next open enrollment, you want to think about what plan you want at that time, because when the day you actually leave is the plan you have to continue with. You cannot change at that time, but every open enrollment, you'll have the opportunity, like you do now as an active employee, to make your changes. You'll get a packet from us every December, the week before we go on Christmas break. You'll get a packet from us. If you continue the plan, if you have medical, we'll send you a letter and what the benefits will be at that time, and you can change it. So if you're thinking about, like if you have the 3769 plan, for example, right now, and you're thinking about, well, I want to go down to the next one down, now's the time to do it during open enrollment if you're planning to retire before the next open enrollment next year. You know what I'm saying? You understand what I'm saying? It's like if you plan on leaving in May, because you cannot change your plan at that time. You have to keep what you had. Now, if you have dependents, but you don't want to continue with your dependents on the plan when you retire, that's fine. You can take what you have or less. You just cannot take more. And you just cannot change the actual option of the plan. Any other questions? Yes. Well, if you go under, because the premiums that we file the Section 125 of the IRS code. So the question is, would it be more advantageous for him to continue on his own as a retiree or go under his wife's through the district? We have premiums that are deducted before taxes. So if you go as a dependent, you get the tax savings, which is 7.65% of your Social Security tax plus whatever tax bracket you're in. So I always use the minimum number of 23% total that you can save going under. So it really kind of depends on what plan you have and what plan your spouse has, whether you like, if you have two different plans, whatever, because you would have to keep whatever plan that he or she has. So it all has to look at the numbers. I mean, the plan is still the same as whether you're dependent or not. When you're paying it as yourself, you can't take the premium off your taxes because you're under your spouse. But if you pay it for yourself, you're not getting that tax benefit. So kind of like you just have to kind of work the numbers. Yes. The question is, if you're taking the medical insurance and you continue it and then you are eligible for Medicare, can you drop it? Yes. We just require that you send us a letter that you want to drop it and the effective date. I do want to say this for the for the dental and the vision, if you cancel those benefits, you can never get them back. So if you do not continue with the dental and vision, if you have those benefits when you leave, you will never be able to enroll in them again. So you might want to keep that in mind if that's something that you want to do. Any other questions? Yes. It's after tax, correct. Because the state doesn't have a Section 125. I believe we send them a report, or they should have like a 1099 that tells you what your amount will be, what you pay towards it. Yes. When you go into drop, the question is, I guess, when you go into drop, but you're going to continue to work up to the 5 years or approximately, in our eyes, you're still active. You are not retired until you exit drop. So like when you tell Vicki, I'm done, I'm out, that's when we stop your benefits, and that's when we offer you the benefits as a retiree. But as long as if you're in drop, but you're still working up to the 60 months or 5 years or whatever, you're still considered an active employee under our eyes, and so you still get the benefits, you still get the board contribution from the board, you still get all of that until you exit drop. Yes. Yes. I mean, we do not take the health insurance subsidy is applicable to the district medical plan, but when we bill you, you're going to be billed the whole amount. We don't take any credit off of that. It's like you get your pension amount, you get your health insurance subsidy added to your check, and then the premium is deducted after that. And then basically you get the net and taxes and all that jazz. Yes. Yes. But even just Medicare alone, you still get it, right? Because that's Section D has Medicare card on that, right? Right. Any other questions on benefits? Again, my name is Karen Cooley. If you have any questions for me after today, after you think of something, you can always call me. My number is 337-8155. Or you can email me at karencc@leeschools.net, or if you're just using the district email, just type in Karen Cooley, Cooley. Okay? Very much.
Thanks, Karen. We had a couple of quick questions. Someone wanted to know about payroll and how the payment in arrears affects their retirement. And payment in arrears, for drop, people who are entering drop, they take there's an adjustment they make in payroll in the next month, and they adjust it and let FRS know that money was paid in June, but it was for May wages, for example. So that's my knowledge of how that works. I don't do that payroll reporting. One thing about beneficiaries. Just because you have a beneficiary here on file at the school district does not mean FRS has your beneficiary information. I see that frequently, and everybody says, oh, I sent in my beneficiary form. Beneficiaries for our life insurance, that information does not travel to FRS. So you need to check and make sure that you have a beneficiary on file with FRS also. One more question? Yes, ma'am.
About the creditable year. Fiscal year starts July 1st. We go to work in August. We don't get paid till August 31st. I retire in September. How many months of credit for that year do I get based on those months?
You would get credit for every month that salary is reported. So when your work year starts. If you're a 10-month employee, every month that you get salary, you get a 0.10 unit of FRS credit. If you're a 12-month employee, your month is worth about 0.08 units of credit because you have to work all 12 months to get one full FRS year of credit. An earned salary, yes. 0.10, because you work 10 months, so that makes up a 1.0. One more question? Okay. I happen to have worked with Margaret way long ago in the ancient days at Sunshine, and Margaret's question is, her drop termination date is actually June 30th, 2018, because she probably, when the calendar was way back in 5 years ago, your drop entry date was, you know, May the 1st or was July the 1st, and you go from July the 1st to June 30th. Well, the school calendar's changed now, so your last contract day is going to be May 31st. You can actually call the Florida Retirement System and let them know your last day worked is going to be May 31st. They will end your drop on May 31st. They will pay out the drop amount that's listed on your estimate for May, and you'll start to get your first retirement check in June instead of July. So that's how that'll work. And the FRS contact number is on my business card or on the website, and you can just contact FRS and tell them that's an early date. You can do it now, 3 months prior to when you're going to end your employment. Yes? Margaret's husband, did you have anything? Yes, sir? Oh, sorry. Yes? He wants to know if he has to wait 6 months before he goes back to work after he ends his drop. If you're going back to work for any FRS employer, yes. You have to wait a maximum of 6 months, and then at the 7th month, you have to fill out the FR23 form. If it's with our district, I would fill that out for you. You just have to notify me. You can't start work until you have that FR23 form faxed to into the Florida retirement system. If you want to go back to work at a charter school that is not an FRS employer, FRS does not really care. What I tell people is make sure that you contact FRS and that you are very certain that you are not going back to work for an employer that is an FRS employer. But if you want to go out to work at Walmart, and everybody always jokes and says they want to be a door greeter, which they really don't, because my husband was a Walmart manager and I've heard all the stories, you can go the next day if you want to leave drop and go to work at Walmart or Wawa or, you know, anywhere else that is not an FRS employer. Yes, sir, you have to wait 6 months if you want to return to the school that you're teaching at currently. One more question? Not from the 7th through the 12th month. You have to suspend all of your benefits, including your health insurance benefit, if you come back to work in the 7th, 8th, 9th, 10th, 11th, or 12th month. You don't get that money back either. Yes, Sonny? His question is, if you go back and volunteer with an FRS employer, is there a violation? Technically, what FRS says is it's not a good idea to go back and volunteer at the school you were at in the position that you were at, because that gives the impression that you're working in the same job you were at before. So you can go back and volunteer, correct?
Well, you can volunteer, but I would dissuade you from doing that because, you know, you may be receiving some sort of pay that isn't monetary, you know, that would create the employee-employer relationship. So I would be very careful about going back and volunteering at all within the first 6 calendar months of your service retirement or in the first 6 calendar months following your termination date from drop, okay? And make sure that you don't get any type of pay. Okay, so, you know, like you may go on a field trip and they may pay you something for going on that field trip. I don't know if you're a coach or whatever, that you've received some type of monetary compensation or benefits or something else like that that makes you an employee. So I'd be very careful in a voluntary, okay, during that time frame.
Yes.
I just have a question going back to how the salaries are, is that your salary only, or is it all the supplements you make as well?
The-
8+1, everything.
She wants to know what's included in salary that's reported to FRS for retirement purposes. I don't have a really good list because I don't handle payroll. What I can tell you is if you are a grade level chair, that supplement is not included in your FRS salary that's reported. Teacher leader funds, I believe, are. Overtime is. Payroll could actually answer that question for you much better, and you could contact the payroll department and ask them and tell them what supplements you have, because everybody has all kinds of supplements, and some are reported for FRS salary and some are not. I'm going to go ahead and let Mike and Rob speak, and at the end we can certainly, you know, go back and have another question and answer session, or Rich stays and I stay, and you guys can talk to us on a one-on-one basis. Okay? I'm going to turn this over to Rob Kemp from Bencor. Thanks so much for coming. I really appreciate it, everybody.
What's going on with this? Is it just me? Good evening. I know it's been a long day for everybody, so I'll try and keep this as brief as possible. My name is Robert Kemp. That's my partner in the back of the room, Michael Stevenson. We represent Bencor, which is the special pay plan for the Lee County School District. I'm sorry, is that a little better? Okay. A couple of disclosures that I need to go through before we get into what the Bencor special pay plan is. We'll mention mutual funds with regards to the plan. Obviously, mutual funds are invested through the market, etc. Another disclosure is any presentations you see through the slide are hypotheticals. They may pertain to some, but everybody's position is obviously unique and different. So who is Bencor? Bencor is basically in about 64 to 67 school districts in the state of Florida. We're in about 27 of the state colleges. And the reason we're there is because we're obviously saving the employer some money with regards to the Bencor special pay plan. Bencor Retirement Consultants is a local independent advisor with decades of experience. We are the people that implement the plan inside the local school district. Basically, this is the structure that Bencor has. We are the administration service. There's Bencor that administers the plan within inside the school district. The funds themselves that are go to Bencor that through the plan is held with Transamerica. That's the custodian. And then there's Mike Stevenson and myself. We are Bencor Retirement Consultants. We're the advisory side of the practice. We have an office here locally in Fort Myers, and we also represent Collier County too. What is the Bencor Special Pay Plan? Basically, you hear the word mandatory and compulsory with regards to your money. There's a negative connotation attached with that. We're here to tell you that all the monies that are sent to Bencor through the Special Pay Plan are your funds, and I'll go through in detail how those funds are distributed to the plan and then your accessibility to those funds. Basically, it's a 401A and a 403B plan, and it's accumulated sick leave. Everybody that accumulates sick leave as they go through the Lee County School District. If you accumulate annual leave, that is also part and parcel of what goes over to the Bencor Special Pay Plan. Who is eligible for Bencor? Everybody that's through the district, whether you're TALC, NON, ADM administrators, you will end up with a Bencor account, and I'll explain that the minimum is $1,000. So if you are separating from service, or rather if you are entering into drop and you have over $1,000 worth of sick and or vacation pay, you will end up with a BENCOR special pay plan. Because you're a public employer, they cannot discriminate on who can participate in BENCOR and who cannot. The underlying rule is $1,000. The only group of people that do not have a BENCOR special pay plan is the SPULC representatives. If you're part of the SPULC union, they never ratified the agreement with BENCOR, so you will not end up with a BENCOR account automatically through your employer. Basically, the BENCOR special pay plan is a benefit to you because it's beneficial to your employer, but by chance, both of you benefit from the plan in exactly the same manner. The savings to you on the monies that go to BENCOR is 7.65%, and I'll explain that briefly on a slide that will show what the actual savings are. Basically, if you took a $10,000 deposit with regards to your BENCOR monies, which is your sick leave, if you received them prior to BENCOR being in the school district, you would have received it as compensation through your employer. Anytime you receive compensation through your employer, you're going to have to pay FICA, which is payroll tax, Social Security and Medicare, and it amounts to about 7.65%. When your employer takes that money out of your check, they have to match it. So it costs your employer 7.65% as well. The rest of it is subject to federal income tax. The more you make, the more you pay. So we have some people leaving leaving their employer with $25, $50, sometimes over $100,000 in sick and vacation pay. So if you receive that all in one plan year, that's typically your highest year when you're leaving your employer, you'd be subject to federal income taxes on that lump sum. The money that goes to BENCOR is deferred into a 401A plan, and by it being deferred, it's no longer a function of payroll, so you don't have to pay the payroll tax. So the money goes in, you save the 7.65%, but so does your employer. So for every dollar that goes to BENCOR, your employer also saves 7.65%. Last year, the district saved almost $1 million by having the BENCOR special pay plan. You also aren't subject to having all those taxes taken out in one plan year because the money's deferred into a 401A, which is similar to a pre-tax IRA, etc. So then once you retire, you can withdraw the monies as you need them, and obviously control how much taxes you're going to pay. The annual contribution limits, it's kind of twofold. It's for people that are just simply retiring, and then for people that are going through the drop program. Basically, the amount went up this year. It is $55,000. That's the maximum amount that can be deferred to the 401A plan. And it's your plan year compensation, which runs on the fiscal year for the school district, plus your accumulated leave and your sick leave. There's nothing that you need to worry about calculating. This is all done through payroll, and it is all done automatically. If you have an idea of how it's done, that's good, but you don't need to worry about, you don't have to enroll, sign up. Payroll does this for you automatically. The main plan is the 401A special pay plan, and that is the plan that will handle your sick leave as you separate from service. If by chance you have in excess of the $55,000 that plan can take, or half your salary at $55,000, there's a 403B plan that can take the excess, and that can also handle $55,000. The only thing you need to be aware of with the 403B plan is that it'll be reduced by how much you may be contributing to your other TSAs. So if you're putting in $20,000 a year, that $55,000 is reduced accordingly, and that's in your final year of separation. Basically, we talked about the 403B and the 401A. That's just the contribution limits. And then the second part of this discussion is obviously the amount that can go in as you go through the drop program. It's a little different on how they calculate it through the drop program. They withhold 30 days when you enter into the drop. Say you enter in June, that's when most people enter into drop. Basically, a year after you've been in the drop program, the district will make a calculation on their fiscal year, and at that point in time, they'll see how much sick days are owed to you. They remove 30 days. They put them aside just as a sick bank in case you might need them as you go through drop, because once those dollars are converted into, once those hours rather are converted into dollars, they cannot get the monies back from BENCOR. So you basically got a 30-day sick bank, and then what they do is they divide that money, that amount of hours by 5. They multiply it by your rate if you're an educator, or if you're administrator, it's a slightly different calculation. And at that point in time, they make that deposit into your BenCore special pay plan. So as you can see, as you go through the drop program, about 1/5 of your sick pay is going to be deposited into the BenCore plan as you go through drop. On your final year of service, that's when they're going to give you back your 30 days if you haven't used them and deposit that last amount into the BenCore special pay plan. And as I said earlier in the presentation, you don't need to worry about having to calculate this, how it's done. Everything's done automatically through the payroll department. Excuse me. Some features of the BenCore plan. Because this plan was established for you by your employer, once again, we said the word mandatory and compulsory, you have to participate. BenCore can't really charge you a fee for an account that you never really opened. So there are no fees and charges inside the BenCore special pay plan at all. There is a safety feature inside the plan, and that's where the money typically goes for your deposits, because you're wondering, okay, they've changed over $2,000 and sent it to BenCore. What happens to that money? It's basically going into the same account, similar to the one that if you're in the drop program that's earning a fixed interest. They declare the rate every they were declaring it in January. I think the rate is good through March of this year, and then they'll declare the new rate for next year. The fixed rate for 2017 was 1.55%. So your money goes into an account with no fees, no charges, and simply earns a fixed interest rate of 1.55%. As you can see in years past, some of the rates have been somewhat higher, but in today's lower interest rate environment, we can see that the rates have been 1%, and then last year they ratified a new agreement with Collier County Schools that increased the rates up to the 1.55 you see right now. The default investment, like I said, goes straight to the stable value fund, which is the 1.55 fixed interest rate. And when you don't have any other options listed, that's where your funds are going to go. You do have a loan privilege inside the BenCore special pay plan. It's important to note that if you're in the drop program, you don't have access to the funds, meaning that once those funds are deposited with BenCore, they have to remain with BenCore until you separate from service. When you separate from service, that liquidates the account, meaning that the account is liquid. You can have full access to the funds. You can leave the funds with BenCore for as long as you would like, but that is actually what gives you full access to the funds is when you separate from service. There's also some investment options inside the BenCore special pay plan. There's 16 different mutual funds, and I'll go through them on the next slide. And also the loan feature means while you're in the drop program, you can access up to half the value of the fund. If you have, for example, $10,000 in there, you can access $5,000 as a loan. What's good about the BenCore plan is that both the interest and the principal you pay back to your own account. They do charge a $75 loan setup fee, but you pay yourself back the principal and the interest on that loan. There's different bond funds, stock funds, and multi-asset funds that you can invest in through the BenCore plan. Like I said, the default investment is the guaranteed fund, the Lincoln Stable Value Fund. You can go online once your fund is established, once your plan is established, and then you can access allocating some of the asset to these different funds. How to apply for BenCore? There's nothing you need to do. Payroll is going to do that automatically for you. If you simply separate from service, payroll will send the monies to BenCore based on the calculation that they'll make. They'll send you a calculation sheet, a worksheet, showing you the funds that will be sent to the BenCore special pay plan. And if you're in the drop program, you may enter in June, and then a year later, you may end up with a BenCore account depending on how many sick days you have. Or if you entered into drop as an administrator or an NON, you may end up with your vacation being deferred to BenCore if you want to have that average 5 highest compensation. That vacation pay can get paid out to the BenCore special pay plan. Once you enter into the drop program, you'll also get notification from myself. I'll be giving people a call. I set up an appointment with them, and I leave them with valuable information on how they can access their BenCore special pay plan online through the bencoreplans.com with a username and password. And I iterate to them that it's important they do so, because once that account is established by your employer, like Vicky said, you may do beneficiaries with your employer, but BenCore doesn't know who they are. So it's very important that you log into the account, input your own personal information, and designate your beneficiaries on that account. The school district will send monies to BenCorp. If you're in the draw program, they send it through every July based on their fiscal year. It typically happens right about mid-August, somewhere around about there. And if you're separating from service, it's typically the pay period following your last pay period when you're with your employer. So if you're not in drop and you simply separate from service, it'll normally be 2 payroll periods following that, and then they'll calculate your sick day. It's different with the educators leaving at the end of May. It may take the district a little longer because obviously a lot of you people leave at the same time. So that may take a little bit more time for them to get that final calculation made, and then the monies will be sent to BenCorp. The monies that are sent to the BenCorp plan are sent to the BenCorp plan trust and then deposited in each one's account individually. Oops. What happened? What's important to note inside the BenCorp plan, all the funds are taxable. So the funds are sent there prior to tax. So every withdrawal will be subject to federal income tax. And because it's a 401A plan, there's a mandatory 20% tax withholding. It doesn't mean whether that's enough or too little. You always pay taxes based on your rate. So you'll simply receive a 1099 distribution form once you've taken some monies out of the BenCorp special pay plan, and then you'll file that at the end of the year when you do your taxes. If your tax rate is 15%, you'll get some reimbursement. If it's slightly higher, you'll obviously owe some more taxes. It all depends on how much you actually take out. What's important to note with a 401A plan as well is if you're at least age 55 when you separate from service, say for example you're 57 years old, you have full access to the funds, you'll pay taxes, but you won't owe a 10% early withdrawal penalty like you would with an IRA. If you are prior to age 55, 54 in the year that you separate from service, you'll have to wait until age 59 and a half in order to gain access to those funds to avoid the 10% penalty. Information is available at bencorplans.com. There's the 188 number that is available as well. What I urge everybody to do is we are the local BenCorp representatives for the county. We've got an office right down the road. Our contact information is in the folder that Vicky gave you guys, the red one, when you came in. In the back of the folder, there's a yellow informational sheet. That's got my contact information and Mike's contact information. If there's anything you need or questions you have with regards to the BenCorp plan, shoot us an email, give me a call. It can be somewhat frustrating calling the 888 number. You can be on hold for a long time. If there's something I cannot handle, I'll obviously then refer you to the 888 number. But we're a free service to you through the district, so utilize us. I mean, that's what we're here for, is to try and help you with questions and implementing the plan itself in the district. There's also a blue contact information sheet in the back. If there's questions you have, or you feel that you have some questions regarding BenCorp or anything of that matter, you can just fill it out, and I'll be making contact with you after this meeting. There are some other optional uses for the BenCorp special pay plan. BenCorp is a pre-tax account. Your BenCorp, your drop funds can be utilized to be deposited into your BenCorp special pay plan. A lot of people utilize that in the county as a feature merely because that once you separate from service, there's the fixed account that you can utilize, and also the funds are 100% liquid. You can gain access to them. You can actually do whatever you like with those funds once they're deposited into your BenCorp plan. BenCorp can also accept other funds from other retirement plans, 403Bs, 401Ks, and IRAs, etc., subject to certain limitations depending on whether you're 59 and a half, separated from service. But those are requirements that we can also use for the BenCorp plan. Basically, the summary of what we went through this evening is we talk about that word mandatory and also involuntary, that you need to participate in the plan. As you can see, it benefits your employer and the employee in exactly the same manner. The retirement plan is for your annual sick leave and your vacation pay. That's deferred to the plan automatically. Employees are obviously going to save the 7.65% on your Social Security and Medicare, and you avoid the taxation of that distribution in that one plan year. 100% liquidity upon your separation from service, and there's no fees and charges in order to gain access to the funds. You can creatively take money out of the account on a monthly basis. You can take money out in lump sum distributions. It's 3 or 4 pages. You fax them into Bencore and they do a direct deposit to your checking account. It's very simple in order to get that set up. There's obviously the loan privilege feature that's in the Bencore Special Pay Plan, and 16 mutual funds, and then the fixed investment option as well. The funds are available at employment separation. Like we said, while you're going through drop and you have funds deposited into the plan, you cannot gain access to those funds, but once you separate from service, you have full access to those funds. All the money coming out of Bencore is obviously subject to federal income tax. The distribution forms can be found online through your website, and they can either be faxed and or mailed to the Bencore website. Once they're faxed in, it typically takes about 5 business days for them to act upon that transaction, whatever it might be. Distributions can be either sent to your home, and they will only send them to the address on record. Obviously, through security features, if you send in information on a direct deposit and your check stub has a different address as opposed to what is on record, they will simply mail it to the address on record. It's just a safety feature that they have. The account information is obviously available online through the bencoreplans.com, and we can also look up information at our office and give you information over the telephone. Drop funds can also be moved into the Bencore Special Pay Plan. A lot of people use this feature in order to just park those funds until they retire, get done with the W-4, the HIS health insurance subsidy, and then they can decide what they'd like to do investment-wise with those drop dollars. Also, other retirement accounts can be also moved into the Bencore Special Pay Plan, and there's certain limitations and restrictions in order to do so. I've already gone through the packet, a couple of the forms, our contact information, etc. And once again, that's our information up on the screen. And there's a silver and box back there in the back. If you would like to have us contact you, just simply drop out the blue form that's in the packet. You can drop it in the box, and I'll be reaching out and making contact with you at some point within the next week or so. That's about all I got. Sure. The question is, after you're done and retired, can you retain your Bencore account? You can retain your Bencore account for as long as you would like. Sometimes there gets a little bit the confusion comes in is because when you separate from service and you're done with the drop program, you have to move the money from drop. You've got that 60-day window after you leave. If you don't, they cut you a check and hold the taxes. So you have to move the money from that account. Your Bencore Special Pay Plan, you don't have to move it. I have a lot of clients that retain the Bencore account. They're making 1.5%, sometimes 2% in there, no fees and charges, and they can access it at any time. It's a good liquidity account for you when you've separated from service. So, yeah. That happens, what is your position with the district? Teacher, yeah. So with the teacher, with anybody that's part of the teacher union, NON, ADM, anybody that is not SPALC, the monies roll over automatically prior to tax, and also you save the Medicare, Social Security, and Medicare tax. If you are part of the SPALC agreement, that does not happen. You can, however, shelter your sick days, and that's something that we can help you with through an employer-sponsored plan. You don't save the FICA, but at least you can save the upfront taxation that's going to happen on your sick days when you retire. Because if you don't set up something, they're simply going to pay you out on them. Yes. You can make them as often as you like. And inside the plan, there's no fees and charges. However, if you're going to move the monies from the guaranteed fund into one of the mutual funds, you will pay a fee that's based on the asset residual just of that mutual fund. They're like about 0.8, 0.9. They're pretty reasonable. It's just like any other mutual fund. Sure. Let's say If you are post age 59 and a half and they've deposited the monies into your account and you separated from service, there is no penalty, period. It's like an IRA. Anything prior to age 59 and a half, if you're at least age 55 in the year that you separate, say you're 56 and a half years old and you decide to retire, your sick days that go into the Bencor Special Pay Plan can be withdrawn. You're going to pay taxes, but you won't owe a 10% penalty. If you move those monies from the Bencor Special Pay Plan to an IRA, you've just subjected yourself to the 59 and a half year rule.
It's 30 years or 60, but I don't have to, or 62. Can I wait for my 5 years? If